This is the Wealth Junkie Show. Brought to you by CEO Capital Partners, Brendan Dukeman and Will Harvey. Your hosts deliver the daily fix you're looking for with exciting wealth-building secrets and strategies for what's working today. Listen to real-life stories straight from the mouths of some of the hottest, most successful entrepreneurs and financial freedom seekers to fuel your success addiction.
What's going on, junkies? I'm Brandon Dukeman here with Will Harvey, and this is the Wealth Junkies Show. Thanks for joining us today. We've got a pretty awesome multifamily guest here for you. But before we get started, don't forget to subscribe to the show and leave us a comment and a rating so we know how we're doing. And join us on Facebook at facebook.com/groups/Wealth Junkies. And without further ado, I'm going to let Will introduce our awesome guest for the day.
Yep. Thank you, Brandon. Excited to have a multifamily Monday here. And today we have Jeff Holst on the show. He is a recovering attorney. That's what he said. Recovering attorney. And now he is a real estate investor. He's got a really, really interesting story on how he got there. He started out in the single family world, just like many others did, including myself. And then he ended up graduating into the multifamily space. So Jeff, really appreciate you coming on the show and taking the time to speak with us. With that, can you just give the listeners a little bit more about your background and how you got to where you are today?
Sure. So that's kind of a long story, actually, but I'm happy to share it. So first of all, thanks for having me on, guys. I really appreciate it. I'm excited to dig into your show. I mean, you guys are relatively new, but it's amazing. So I love what you're doing. But anyway, so I got involved in real estate actually pre-crash. So 2000, say 4 or 5, somewhere around there. I was, I'd read all the, normal stuff that everyone does, a rich dad, and played the Cash Flow 101 board game and all that stuff. But then I really got involved by buying a single family house and living in it and renting, a couple rooms out. That's probably the first deal I did. And then when I went to law school, I actually kept that house and kept renting it out. The payment was stupid cheap. It was like $400 a month or something. So,
oh, wow. Where was this at?
This was up in Michigan. I'm from Grand Rapids. So, so that was in Grand Rapids. And yeah, I mean, it was like a 700 square foot, 2-bedroom house with a semi-finished basement. And so it was the classic house hacking kind of
right.
Nice.
So that's kind of how I got started in real estate. Although my family had some rentals, so I had some exposure to it. My dad had 3 or 4 houses when I was growing up. And so I would do things like, mow the lawn or, clean out, trash from turns, stuff like that. But not a whole lot of that. I mean, I just, had that little exposure to it. And then I went to law school, and I kind of got out of the idea of doing real estate. I mean, I liked the concept. I met a guy in law school who was flipping houses to pay for law school. And he's now a good friend of mine and a partner in a lot of the properties that I have. But I didn't really do much then. And I started practicing law 2007. And in 2008, I was actually diagnosed with leukemia.
Oh, wow.
So, and that kind of threw a loop in my life plans.
Just a bit.
Right? Yeah. So I just got out of law school and, I had lived a pretty good life. I went to law school a little bit late. I had a master's in business also, and I took a year off to travel. So, I mean, I had done a lot of really fun stuff at that point in my life. And, I'd gotten married and started this law firm, and we were like, everything's coming together, it's going to be perfect. And actually a week before I got diagnosed, I was in Peru in Machu Picchu. And I had kind of like checked the last thing off my bucket list. So pro tip there, if you have a bucket list, never finish it because you're going to get leukemia like the next week.
Keep adding.
Yeah. So you don't want to do that. So I got home from that and had another attorney that worked for me. And he actually quit like the week before I got diagnosed. So we went from having 2 attorneys to 0 essentially overnight. Wow. And it actually drove me into personal bankruptcy. So I was a bankruptcy attorney, and filed personal bankruptcy.
That's ironic.
So, yeah, it's ironic and terrible, actually. That's like when you just say, screw it, I'm going home. I'm just done with this. So I ended up taking a job. I moved to Chattanooga, took a job working for a trucking company, made pretty good money. And that was like 2010. And the market was just stupid good for real estate. And I knew I didn't want to be in a situation where I couldn't pay my bills if I couldn't work. So I was like, I'm going to take this money I'm making right now and I'm going to start buying single families. So I called up my buddy Travis, the one I met in law school, and said, hey, what can we do? And we just started buying stuff. The first thing we bought was a condo for $30,000 cash. This is right at the bottom of the market. It was a $120,000 condo 5 years earlier, or really probably 2 years earlier. And it was a bank-owned foreclosure, and we still own it today. It's probably 150 again. It's
that's incredible.
Yeah. So that's sort of how I started in real estate, and then we just kept doing it. I was working, so we just rolled all the money we made back over, and we had to get a little creative because I didn't have credit, right? Just filed bankruptcy. And didn't have credit, and I didn't have really that much money. So once we tapped out our personal savings that was pretty small at the time, it was just whatever bonuses I was getting at the time and things like that. We just started doing some private money deals. We had a couple of investors that we kind of gave them a chunk of equity in a company. So what we did is we formed a company with one guy in particular. We each took a third of the company, and then he would loan money to the company at 6% interest only, and then we'd go buy stuff. So he'd get paid interest, and then we'd split everything up after that.
That's a great deal.
It worked out really good for us because we didn't have any other options, and it worked out good for him because now he's got a ton of equity. He actually ended up loaning us about $1 million over a few year period. So we ended up buying a lot of stuff. That's a great
contact to have.
Yeah, it worked out all right, right? I mean, if I knew what I knew now, we might have got into multifamily already back then, right? Yeah. And then we would have been way ahead of the game. But we did that for a while, and it got kind of tedious. Between my partner in Detroit area and myself, we ended up with like about 450 single family homes, mostly free and clear other than this private money loan.
You said 450 single family homes?
Yeah. I mean, about 150 for me and my partners. And then my other partner had about 250, 300 of his own as well. So
that is a lot of freaking houses.
Yeah. Well, these are like, a lot of these were $5,000 houses in Detroit that are now maybe $30,000, $40,000. So they were lower income properties that needed work, which is, maybe even worse in a way because it's a lot of work. And he has a property management company up there, and he still manages several hundred properties. But we started 1031ing those into multifamilies a couple of years ago. So that's kind of how that's the sort of short version of my life. So
wow. Brandon.
Go ahead. What made you come to the realization that maybe multifamily is the right way to go?
Well, so I started reading about 4 or 5 years ago, about cap rates and value add deals and how much opportunity there was there. And so I started getting intrigued by that. And I knew that there was a scale issue that we had, right? We couldn't just keep buying single families and duplexes because we did have some small multis, right? Duplexes, a couple of triplexes and stuff, but we just couldn't keep buying those and continue to grow.
Right.
And so we really needed to do something different, and because we weren't leveraging, and a lot of those properties are frankly not leverageable at the time. They're getting that way now, right? Like this is why the prices have gone up so much, is that, some of these neighborhoods have really turned around, but when you have a $20,000 house, you can't leverage it. It's very difficult to do that.
Right.
But when we started 1031, we'd sell like a package of 10 houses. One deal we sold 10 houses and bought a 32 unit apartment complex. And we moved right from, no debt to having a pretty good chunk of debt on that. But it's a non-recourse agency loan, right? So it's one of those things where, from our perspective, our risk exposure really isn't any different than the equity that we had originally. And we get significantly more cash flow, and we were able to raise the rents about $200 a door on that since we bought it a couple of years ago. So things just a beast. I actually kind of wish we hadn't put agency debt on it so we could refinance it now.
Right.
That was the first agency deal we did, and we have a pretty terrible prepayment penalty because we didn't know what we were looking for.
What is it? Is it defeasance or yield maintenance?
Yeah, yield. It's 9.5 year yield
Oh
maintenance.
wow, that's crazy.
Yeah,
so
it's real bad.
Can you just explain real quick what yield maintenance is?
Sure. So, it's kind of complicated to wrap your head around, but the idea is that the lender wants to make sure that they preserve their expected profit over the term of the loan, or in this case, over 9.5 years. And so if rates are going up, it's not so bad of a penalty, but if rates are down or like dropping, they're going to compare your current rate, what they expect to make in interest over the remainder of that 9.5 years, to what they can get on a 9.5 or less year bond rate. So like that could be like 2%, and we're paying like 4.5% on that. So we would have to pay 2.5% for the remaining, like say 7 years that we have left on that. In order for a prepayment penalty, which is pretty significant, right?
Yeah.
I mean, that can be a big chunk of cash. In that case, I think it's close to $100,000 that the prepayment would be. And that's
so that could
and it goes down every year, obviously. And if rates go up, it goes down. But rates haven't gone up. I mean, they've actually come back down the last few months. So we're really in a situation where we're pretty much tied to that, which is fine. I mean, I just don't like the idea of having cash, a whole bunch of equity tied up that we can't tap. Right. Particularly since it's our equity, right? It's not like, it's not like it's split up a whole bunch of ways. This is just ours. So
right. Well, I want to go back a little bit. So in 2005, that's when you bought the first property. Is that right? You house hacked.
Yeah. So I actually probably bought it a few years before that, but the payment was really cheap. So I just lived there. I was working at a 7-Eleven third shift, and I just went and lived there, by myself.
How did you tell us you were working at 7-Eleven? How did you finance that? How did you pay for it?
That was an owner finance situation, land contract. I mean, it was a family deal. So it was like a rental property that my grandmother had owned at the time. So I bought it from her.
Okay. So you bought it from your grandma, and she held the paper on it.
That's right.
And you basically, she transferred ownership of the property, but then you paid her back. She held debt on it.
That's right.
Paid it to her so that you didn't have to come up. How much money did you have to come up with out of pocket?
None. That's family thing. Yeah, it was a pretty good deal for me. And it was, the prices were pretty cheap then, and then they went up a lot in 2005, 6, and 7, and I ended up selling that to my brother, and then and actually turning it over to him for a pretty good price. And letting him, and she continued to hold the paper for him. She was like, it's my brother. So like, it's her grandson. And so she did that. And she was just happy because she didn't want to, deal with renters and things like that, because she was getting up in age. She
trusted you more than a renter.
Yeah.
What I got to ask, what interest rate was she charging?
I think it was 6%. It might've been 7. It was somewhere in that range. It was comparable to what we could have got at the time.
Yeah.
That's
cool. So she gave you the discount on that, because you wouldn't have been able to. I think that's right around where conventional money was back then.
That sounds right. Yeah.
Yeah. So that's really cool. That's so I assume that on your own working at 7-Eleven, if you didn't have any renters in that property, you probably wouldn't have been able to afford it. Is that right?
It would have been tight. I mean, I think I was making like $250, $300 a week then, and it was a $400 payment. So it wasn't like super high. Okay. But it would have been tight. But actually there was another guy that was a high school friend of mine that worked at 7-Eleven. And he ended up moving in shortly after I bought the place and taking the other bedroom. So we just kind of split it. I wasn't trying to make money. We just said, hey, like I figured it cost me like $600 a month, and I was like, you can pay me $300 a month, and we're, and then it'll be half the price for me, basically.
So real quick on that, we all know what house hacking is, but for someone who's listening who doesn't know, the term house hacking, can you kind of explain what that is and why it's beneficial?
Sure. So, I mean, this is a little different than your traditional house hack, but basically house hacking is when you use some kind of owner-occupied financing in order to get more favorable terms, and then you generate some income for it. So it could be something like buying a duplex and living in one side, getting an FHA loan on it, so you have a low down payment. But it could be something like I'm describing, where you have like a roommate or two. And another way to do it is really to buy something, live in it for a year or two, and then instead of selling it, renting it out and then going and buying something else, because you get more favorable financing as an owner occupant than you do as an investor. And so that's the real reason for house hacking.
Yep. It's such a great way to do it. That's exactly the 3 single family, well, not including the one I recently bought, but the 3 I bought, the first 3 single family homes, I bought them exactly that way. I was in the mortgage business, so I understood that primary residence loans are much better than if you were to buy it as an investment property. So doing it that way, you buy it, you live in it for a year, and then you can move out, buy something else. You fulfilled your obligation to the lender, and you can keep doing that. So so it's pretty cool. You're exactly right. So after once you were in you had your law practice and you were doing all of that, what made you want to look outside of that, beyond that, and really do something bigger?
Right. Well, I mean, it was getting sick, right? So for me, like that puts I thought I was going to die. Like, it's not like I got sick and I was like, oh, I can't work for 6 months and I'm going to go back to work and be fine. But my leukemia was pretty bad. I'm very fortunate because what I have is called chronic myelogenous leukemia. And they came out with a sort of miracle pill. It's a daily chemotherapy. I still take it now. It's very expensive, but insurance covers it. So whatever. But if that hadn't come out right around the time that I was diagnosed, like the 5-year survival rate 2 or 3 years earlier was less than 5% for the type I have. And then I was pretty advanced actually, because you're young and you don't go to the doctor a lot. And
Right.
I had my white blood cell count was like 250,000, and it's supposed to be like 4 to 10,000. And I had a cousin who died of leukemia a few years before I was diagnosed, a different type of leukemia and completely unrelated, but her white blood cell count had gotten to like 150 when she died. Right. So
No
like,
kidding.
so I was like 100,000 above where she was. And, they didn't know what type of leukemia I had because they got to do like bone marrow biopsies and all this stuff. So I spent about 3 or 4 days under the impression that I was absolutely going to die in the next several days, right? Like I was like, I'm done.
Kidding.
Like, I remember my dad said to me when we were in the emergency room the first night, he said, if you live this is in September, he says, if you live till February, I'll take you to Australia. And I said to him, I'm not going to live to February. I'm just hoping I can make Christmas, right? Like I want to have like one last Christmas with family. But I was actually okay with it. I know that sounds
so sad.
Yeah.
That is crazy.
Yeah. It's weird. I mean, it's sad, but it's also really good. Like in retrospect, like I wouldn't wish this on anyone, but in retrospect, what it did is, to answer your question, is it made me focus on that you really only have one life and you only have one chance at it and you don't know how long it's going to go. So whatever it is that you want to do in your life, you've got to do it like right now. Right. So, and that's, that's sort of the driving force on everything I do now. I told you guys off the show that I'm, working on a new podcast, and I said I probably wasn't going to mention it, but whatever, it seems right at the right time.
Yeah.
So like I'm working on a podcast called Last Life Ever, where it's not even out yet, but it might be by the time this comes out, where it's just interviewing people that are doing whatever it is that they think is, perfect for them. So, and that's for me. I've always loved real estate. I mean, I was the weird kid that like snuck out of his bedroom and watched late night TV. And the late night TV I watched was like Carlton Sheets, No Money Down. You guys probably don't even remember that because I'm older than you, but it was like a late night infomercial guy selling a course for no money down real estate investing. And I was like, man, I want to do that. Like this guy's sitting on a, chair by a pool in Hawaii or Florida or something. And that just looks amazing.
Yep.
And, so I've always wanted to be in real estate, and I just kept putting it off. I mean, I remember 17, 18 years old going, oh, like I should buy this house. It looks good. And if I'd started doing that when I first thought about it and then I got sick, I wouldn't have ended up bankrupt. I know that for sure. I would have had income, right? And the big problem was I couldn't work. And then we had the law firm, which was eating like $5,000 or $6,000 a week, which is, it's a big nut to crack.
Yeah.
Don't have any money coming in.
No.
And we paid all of our bills actually for like the whole time I was sick by using credit cards. Like we paid the law firm bills and everything because I had pretty good credit, but it turns out you can dig yourself a really big hole that way.
Yeah.
I bet.
And I mean, I kept thinking, well, it's only a couple more, weeks and I'll be back to work and, we'll just figure it out later.
Right.
And then also I was a bankruptcy attorney and I thought, well, if I die, then I won't ever have to pay this back. And it's all in my name, so it won't hurt my wife any, so I might as well give it a try. in retrospect, I'm not sure that was the right strategy, but I mean, I
was like, crap, I lived. What do I do now?
Yeah, right. I guess that's about right, actually. I mean, I really did think I was going to die. Even for months after that, I thought, there was a pretty good chance I wasn't going to make it.
That's unreal.
But yeah, it does. It changes your perspective. And so that's why I got into real estate and figured that if something happened to me, my wife would be okay. And I think now if I die, she would be annoyed that she has to deal with all the real estate that we have. So it could be worse, right?
No, that's so cool. Well, like going forward a little bit, we've kind of went forward back. This is like a Quentin Tarantino movie where we're, playing it out of sequence. But going forward, once you have all those properties that you were buying for pennies on the dollar after the recession was once all the value was wiped away from a lot of the properties across the country. And you mentioned that you were doing 1031s into these apartment buildings. Can you just talk a little bit about that, what a 1031 is and how it went for you?
Yeah. So, I mean, we haven't done that many of them. I mean, we've done 3 or 4 now, but what a 1031 exchange is a provision in the tax code that allows you to roll forward capital gains. So if you have a lot of capital gains, and in these houses we did, right? Like we bought them for 5,000, we're selling them for 35 or 40,000. If you have 10 of them, then you're $300,000, $350,000 gain on a $400,000 sale price or something like that, right? So there'd be a significant amount of capital gains taxes that we would owe, and by rolling that forward into another deal. Now you have to follow the rules. It's not easy. You need to get an expert to help you with this. You need a qualified intermediary. You have to do it in a certain timeline. I think you have to identify a replacement property for whatever you're going to buy within 45 days of the closing of your first deal. You can't ever touch the money, so it's got to go to an intermediary. So there's all these hoops that you have to jump through, and you definitely want to, have someone advise you on that process. I'm not giving tax advice here, but if you follow all those rules, you can avoid paying the capital gains by rolling your lower basis forward, as long as you buy something bigger. So in this case, we bought something that was significantly bigger. So the fact is, our basis, if we paid, I think $1.5 million or something for that first deal, our basis in it isn't $1.5 million because we had this low basis in this $400,000 down payment, but our basis is like, $1,200,000 instead of, $1.5 million. So we still get a benefit of a lot of depreciation and stuff. But we don't ever have to pay that tax until we sell the 32 unit, which, since we have 9.5-year yield maintenance on it, might not be for a while. So we're just deferring that tax out for a really long time.
Oh, and then you could 1031 that, correct?
And in fact, we probably will, because there's, it's a value add deal. So there's a ton of equity, as we mentioned, and then we have a down payment. So, and then of course, if we do hold it for 9.5 more, years, there'll be a significant equity pay down as well during that time. And so, our situation is like, then you can go roll that into a 100 unit or something that we can own. And again, without having to bring in more partners and more outside money and stuff. So it's a really good thing.
Yeah. So to dumb it down, because that's how I think, is you basically take your little tiny houses, your greenhouses on the Monopoly board, and you're essentially trading them for the red hotels. That's kind of how that works.
Yeah, that's exactly what Kiyosaki said, right? That's like his magic formula. And I think in the cash flow quadrant, he brought that out. He said, the whole point is to do, buy 4 greenhouses and get 1 red hotel. And if you do that, you're in good shape. And that's essentially what we did, right? It's 10 greenhouses for an apartment building, but it's the same concept.
That's cool. Well, let's talk about more of the red hotels. Can you tell us some more deals that you've done and
Sure.
successful?
Yeah. The first couple of deals we did actually were smaller deals. We did a 12 unit and a 19 unit. Both of those are going really well. Bought those a couple of years ago. We've raised the rents a lot, which means we've created a lot of equity, in those. So those are good. And one's in Georgia, one's in Metro Detroit. And the one in Georgia is kind of by me. I'm in Chattanooga. So it's like, 15, 20 minutes from Chattanooga. So I kind of handle that one, and my partner handles the Detroit stuff. And then we just, this year we bought a 41 unit, which is pretty fun. That's the biggest unit count in a single place that we bought. The 41 unit, again, we didn't go out and raise a bunch of outside money or anything. We just bought it. I own a quarter of it, and there's a couple other guys involved in it that own other chunks of it. And that's it's a value add deal. We bought it super inefficiently run at the time we bought it. We've actually raised the rents by almost $10,000 a month in 6 months that we've owned it. So
can you explain how that works with coming in and buying a value add where it's underperforming, sure, and then you create a lot of value?
Yeah, see, that's the whole reason to get into multifamily, I think. Yeah. It's where the real money's made. So these assets are priced on a cap rate basis. As single families, duplexes, stuff, they're priced like on comparable sales. And cap rate it's a metric of comparable sales because it's like a market comparable sales. But instead of saying, I'm going to compare this 19 unit to another 19 unit, because there aren't that many of them, they look at it on an income approach and they say, how much is the net operating income, which is all the money it makes before you make your loan payments. And so, and income tax payments too. But so they look at the NOI and then they say, hey, like, just to make the math really simple, if you're in a market where it's a 10 cap, which I don't think there are any markets like that anymore.
If there are, call me.
Yeah, no doubt, right? But if it's a 10 cap market, what that's saying is the investors in that market are willing to pay, whatever price is necessary to produce a 10% return. So if an asset produces $100,000 a year in annual income, and it's a 10 cap market, it's worth $1 million. So if you're able to raise that income from like 100,000 to 120,000, then that asset is now worth $1 million too. And it doesn't really matter how long it takes you to do that. If you can raise the income in 3 months, then you've produced $200,000 in equity in that hypothetical scenario in 2 months or 3 months. And that's what the situation on this 40 unit is. It's not a 10 cap market, but the lower cap rate markets, of course, that multiple becomes even bigger. So like if it was a 8 cap market, and you increase the income by 10,000, instead of producing 100,000 income, you produce about 120,000 ish. I didn't run that on a calculator, so I might be off a little bit, but you're just going to divide that by you're just going to divide the income by the cap rate, and that's going to tell you what the new value is.
Yeah. And what's even cooler is as you improve the property and you take it from, say, a C class property to a B minus property, your cap rate actually shrinks a little bit because you
get double benefit. Yeah,
you got a nicer product, and so it's like this this crazy multiplier effect. It's really cool, and that's how you build wealth, and it's non-existent in the single family world.
Yeah, but it does work in other commercial products too. So people don't sometimes people think it's only a multifamily thing, right, but you can do this in like office buildings and strip malls, or any kind of commercial property, and anything over 5 units. So like 5 units and up, pretty much it counts. So
have you done any outside multifamily, other asset classes?
Yeah, so we last year, my partner on my real estate show, because I have a show, I think I told you that before, but so my partner on the show and I actually bought an office building here in Chattanooga, and then we also bought a strip mall. That's why I mentioned those two, just because they're the ones I'm most familiar with. But he also has a industrial flex space, which is pretty cool. I kind of wish I'd bought into that with him, because those things, it's a different market when you're dealing with it, because you're not dealing with, annual lease renewals. So you're locking the rents in for a lot longer period, but you're also going to have longer vacancy periods, right? So if you have an office space that's empty, it might take you 6 months or a year to fill it. Where if you have an apartment that's empty and it takes more than a couple of weeks, you're really not doing that good of a job, right? Like it's a different, there's a different way to analyze it, and the underwriting is more complicated because of that. But there's very predictable income once you sort through those issues, especially if you have like credit tenants, which are like tenants that have solid credit ratings, national tenants and stuff. You can pretty much, and they're going to trade at a lower cap rate as a result of that. If you have really high quality tenants, it's going to give you a lower cap rate. And that means if you have rent escalations, the value just kind of goes up on its own. It's amazing, actually. So they can be really cool. Yeah. It's harder to do value add, I think, in that stuff, because if there's a problem with it, there's usually a reason for it, because their operators tend to be more sophisticated.
Right. So if there's a problem, it's usually bigger, and it's not something where you can just come in and easily solve it. It's like way bigger and deeper. Because
The exception, I think, is if you get into the mom and pop size stuff. So like we kind of targeted with these two deals, like the $1 million to $3 million range. Cause under 5 million, the big players aren't interested.
Right.
And over $1 million, it scares a lot of people away. So there's kind of a soft spot, at least in Chattanooga, in that market there. So what you can do is you can find stuff that maybe somebody's owned it for 15 or 20 years and for them, they feel like they're doing really well because they're getting a good return on what they paid for it, but they just haven't kept up with the new market rates and stuff. So in our case, we picked up properties that were like 70% occupied, that cash flowed as is, and then we were really aggressive about filling the space, and we haven't filled it completely yet on the strip mall, but I mean we've improved in that operating income on both properties, and we're pretty happy with where we're at a year into those. So.
Man,
that's awesome.
That's exciting.
Yeah.
So talk to us a little bit about what your future plans are for, you have a set goal number of units that you want to acquire. You want to dive into some different asset classes.
Yeah. So, I mean, I do want to, I want to keep growing in the multifamily world because I think it is actually, that's where the real money can be made. I don't think about, at like the number of units. Like a lot of people are like, oh, I have 2,000 units, but they own, they're multifamily syndicators and they own like, 3% of 2,000 units or something.
Right.
And to me, that's like, that's great and everything, but I'm more interested in like the cash flow and lifestyle issues. So if I have 200 units that produce more than your 2,000 units, I'm happy with that. And we're at about 140
Agreed.
right now. We're going to continue to grow that. And we're going to do a little bit of syndication and raising and stuff like that. We've done a little bit already. But we're going to, we felt like for our pool of investors, and we have some good investors already, we didn't want to bring them into anything that we didn't fully understand. So we just wanted to do it ourselves first and make sure we knew what we were doing before we brought anyone in. And I mean, because if you're going to raise other people's money, the most important rule is don't lose their money, right? That's like the first thing.
Yep.
And then the second rule is whatever you tell them they're going to get on a return, they need to get at least that much, right? Because if you tell someone, hey, I'm going to get you a 20% return, and then you get them an 18% return, like I'm happy if someone gets me an 18% return, right?
Sure.
But if someone told me that I'm going to get 20 and then I only get 18, I'm not super happy. I'm
right.
pissed,
And we
right?
wonder where
I was
other
planning on
2% is.
I'm spending my 20% and I'm not getting it. So you have to model this stuff really conservatively, and you have to really understand the numbers first. So that was why we really wanted to, get a couple years of experience before we got into that. And so just now we're starting to play in getting into some bigger deals and things that we can't do with our own capital. And we have a couple things we're working on. So hopefully we'll have some good stuff in the future.
That's awesome.
So this just popped up. Was there a difficulty in finding your first deal and getting that closed, just apartment wise, just from the broker standpoint or closing standpoint and loan?
Yeah. So, I mean, I think I overpaid for my first deal.
Mm-hmm.
That's, not a lot, maybe 20, 30,000. It's a small deal, 12 units, $600,000 purchase price about, probably could have got it for a little bit less. The biggest challenges there were like, I didn't know what I didn't know. Right. And we were doing that, it's just us, we're trying to figure it out.
Absolutely.
And that one I actually did just with my dad. So it's just the two of us, right? And my dad's not super active in real estate. I mean, he's, a little bit older and kind of retiring and stuff. And so it was like, if I didn't know it, then it was a problem, right? Like it was. So I felt comfortable with the deal, and it's worked out really, really well. Actually, it's probably worth $850,000, $900,000 now. So I can't complain. It's only been a few years, right? Because we've raised the rents and we've got that. But I mean, it could have been even better, I think, if I'd been more on top of the numbers. I misallocated some of the expenses. I mean, they were a little bit higher than the broker told me they would be, which turns out that's pretty common in this world, right? Like the
really, a
broker?
They didn't tell you the truth?
Yeah, I know, it's crazy, right? Yeah. So, I mean, I think I would, I definitely think looking at more deals would have been smart. But on the other hand, it's worked out really well because I think of where we ended up in the market cycle helped, of course. And then also because I knew the area's rents, and so I knew the rents were low. So I had that's the great part about value add stuff. If you know some stuff, then you have a lot of fudge factor, right? Because like,
that's right.
I could have had a little bit more NOI if I had gotten the expenses down, but I'm talking about $10,000 a year that I, sort of miscalculated. And that's, it doesn't sound like a lot, but, in an there's probably a 7 cap market there now. That's $100,000 plus, $150,000 in equity that could have been there if I had realized it. But fortunately, we've raised the rents more than that, so we've offset all that and then some.
Yeah, that's the cool thing about real estate is that over time, cash flowing real estate just tends to rebound, and it just tends to correct as long as you maintain the property well and do all things right. It just seems like I hear these horror stories where people overpay for these properties, but they have reserves or they're able to ride it out somehow as long as it's a cash flowing asset, and it just ends up correcting, especially in multifamily. And it sounds like yours is, you might have overpaid, but it sounds like it's doing great.
Yeah, no, it's totally fine. And I mean, I'm actually thinking about refinancing it now. So there's enough equity that it's worth considering that even.
That's awesome.
Yeah, or maybe selling it or something. I don't know, 1031 into something else. But
good problem to have, right?
Yeah, that's right. I mean, but I do like the cash flow too, right? So it's nice. I get a check every month and I, can spend it on, movies or something or travel or whatever I want to do. But the thing is, like, the other thing to think about when you're just getting into multifamily is that the financing is a little tricky, right? So, a lot of people might have relationships with local banks because they're buying single families and stuff. Well, we were buying ours for cash, so we didn't really have any of those relationships. But I was fortunate because of what I did in my day job, and I since have quit, so I only do real estate now. But
hey, congrats! That's awesome.
Yeah, no, it's been I quit at 38. That was a big goal of mine, to quit before 40. And then what happened is the company I worked for was selling to a bigger company, and I was going to get a little severance. And I thought, well, I was going to quit before 40 anyway. I'm almost 39. I'm just going to try to make it work now. And I probably quit a little too soon, but I also feel like maybe I quit a little too late, because it was really once I was free to have more time to think about this that we were able to get into multifamilies, right? So,
oh wow.
So if I'd quit faster, I might have had the time to, and I might have been more motivated to get into it, right?
Right.
I didn't have
Something
that.
You said there.
Yeah. So you have to kind of balance that. Like, you don't want to quit and then like have to try to go get loans when you don't have any income. But if you have some real estate already to support your lifestyle, or if you have a spouse that's working, you might want to jump faster than you're thinking. Once you've, obviously you want to analyze it and make sure you can afford it. Right. And all that stuff. I'm not encouraging people just to quit their job and then figure it out, because that's risky too. But but I think people can overestimate how difficult it is to work for yourself in this kind of world. Anyway, so the financing would be tricky, but my day job, I was financing semi trucks. I was working for a trucking company, and so we had some banking relationships because we borrowed millions of dollars. I mean, semis are crazy. They're like buying houses, right? Yeah. Like a new semi now is about $150,000.
Is it really? Wow.
Yeah. So, I mean, that's like literally like buying houses. And, we were buying, 40, 50 of these a year for the company. And so I built a lot of local banking relationships out of that. And I was able to leverage some of those, my own credibility from having, knowing the lingo and stuff like that really helped. And then having the relationship. So, and I think when you're dealing with regional banks and when you're dealing with, sub $1 million loans, that's almost all you're going to deal with in multifamily. So if you're buying 12 units, 15 units, 20 units, stuff like that, you're going to deal with a lot of regional banks. There's small banks, community banks, things like that. They're going to put it on their asset sheet. So they're going to want to know that the person that's buying it is a good credit risk for them, a lot more than you get to the agency stuff on the bigger deals. And they're just looking at the deal. They're not even, they want to make sure you have liquidity and stuff like that, but it's more about the deal and less about the operator at that point.
Yeah. That's right.
That's your knowledge of this is it's great.
So valuable.
I love it. But we're going to jump into our moments of truth section here. It's the same 7 questions we ask all our guests, and going to knock out the first one here. Who is your success role model?
Oh, well, so I should have had a preview of these so I could think about this, but that's
our fault.
Yeah, no, it's all right. It's probably mine. You might have even sent it to me. I've been lazy lately. So, so I'm going to answer 2 people actually. So, in a way, I think my dad is a big part of that, because my dad was always dabbling in small businesses. And like I told you, he had some real estate, and I partnered with him on a number of deals. And even though I have a different perspective than he does. Growing up in a family where it was okay to talk about money is huge, right? That's the whole rich dad, poor dad thing, right? It's like, my dad's, fairly well off. He's not, super wealthy or anything. But he's lived his life in a way that, he was always thinking about, the numbers and like talking about it. And it was a fair topic. So I think that's super. If I had to narrow one person, that's probably who it is. But the other person is, Kiyosaki, because like, even though I don't know him personally, like if I hadn't read Rich Dad when I did, there's no way I would be where I am. And actually I even paid money recently to go to an event that he was speaking at, like extra money to get a meet and greet and a photo with him, because I just wanted to shake his hand and say, it was like $1,000, right? Extra to like, cause he's good at making money, it turns out. But I was like, you know what? I'm totally willing to pay $1,000 to shake this guy's hand and say, hey, thanks for this. And he was, he's a trip too. He's really interesting when you meet him in person. I don't know if you guys have ever heard him speak live, but
not live, but I hear him on podcasts. He seems to be a little rough around the edges.
He's even more rough live than he is on podcasts. He's fully uncensored when you're in person with him. So.
Oh, that's great. Yeah. That's awesome. What's your biggest success?
My biggest success is probably being able to live the life that I want to live, which is, I think, a really fluffy way of saying that that I have a pretty good life. But like, I look at it and say, like, I could say, hey, I graduated from law school. I'm the graduating class speaker in law school. That's great. I have an MBA. That's great. All that stuff is cool. But at the end of the day, the more important thing that I've done is I've constructed a life that works for me, right? I'm doing the things that I want to do. Like I was in China 3 weeks ago. I was in Puerto Rico a few weeks before that. I'm going on a cruise next week, going to New Orleans for Halloween. That's 2 weeks from now. Obviously when this comes out, I'll have already been back from that. So if you guys are in New Orleans at Halloween last year, feel free to stop by and see me, but it'll be hard unless you have a time machine. And I'm going to Tanzania in February. I'm going to climb Mount Kilimanjaro. So I'm just doing all this really fun stuff, and I'm able to do it because I've created a lifestyle that allows me to, have processes in place that take care of this stuff. And I might have to take a phone call while I'm, in Tanzania, but that's not that bad of a problem.
Right.
No,
not at all.
It's like, I think it was MJ DeMarco that said something like, it's a bad deal to trade 5 days of your life for 2 days off, right? In the Millionaire Fast Lane. And I've always since I heard that, I was like, that's super smart, actually.
That is good.
And then also he said, it's an even worse deal to trade 50 weeks of your life for 2 weeks off, right? Because time is the one thing we can't get back. So I'm like, I need to construct a life where I have I'm really not trading any time. Like I want to just have my time to be my time, so I can come on this podcast in the middle of the day because I'm not at work. Right.
Love that.
Yeah, very true. That's the most truth I've heard in a while. So what's a typical day for you look like?
Well, I do stuff like this a lot. Not that I'm interviewed constantly. I don't mean to imply that, but I talk to people about real estate. We film our show, a couple times a month. I look at deals, I'm underwriting stuff, but I'm basically just engaging in real estate and traveling. And so I don't have a typical day because some days I'm working super hard putting together a presentation about something that I need to pitch to someone or whatever it might be. And then other days I'm like, go out for drinks at noon and hang out with friends. The biggest problem is finding people that can go out for drinks.
Right.
At
absolutely.
Noon. So if you guys get to Chattanooga and you want to hang out, you let me know because I'm pretty free on that sort of stuff if I happen to be here. So
that's a good problem to have where you can't find people that, they have their job, you don't. So it's like, who do you hang out with?
Yeah, like lately what I've done with my spare time is I'm writing a memoir, actually. So talk about sort of my story and, how I got here. Because, I gave you guys the short version of it, but there's a lot more to it than just I was diagnosed and then decided to do real estate. So,
yeah, that's awesome. What's your favorite quote?
Well, I almost feel like I should have just saved the MJ DeMarco one, right? Because I don't know that I have a favorite quote, but if I had one, I think it would be, and I don't even know, it's a paraphrase, but it's something I think Richard Branson said, which is that the difference between successful people and unsuccessful people is that successful people take action before they have all the possible information. And I like that because what he's saying is, you can't possibly know everything.
Right.
And if you just spend all the time trying to find all the information, you're never going to take action. And like, to be successful in life requires action more than anything else. Action is super forgiving. Like if you point yourself in the generally right direction and start walking, you're going to get to where you want to go, because you're going to get closer and you're going to be like, oh, I missed a little bit and I need to make this little course correction. And that's kind of a Richard Branson thing too, right? Because if you have a rocket, because he's big on rocket ships, you know, they launch to space, and then when they get to space, then they are like, okay, we got to target to where wherever the satellite is, or wherever, you know, we're trying to go to. The first thing is just getting started and getting out of that gravity, right? Once you have the inertia, then you can make small adjustments to get to where you want to go.
Yeah, just do it and then start figuring it out piece by piece, kind of similar.
Yeah,
to that.
that's a common theme on here. People talk about that all the time. So if you're listening to this, it's such a true saying that their paralysis by analysis is definitely something that holds people back and that you don't want to do. You know, take action, shoot first, ask questions later.
Yeah. No comments on that from my end.
Yeah.
I don't think, I mean, it depends on who you're shooting, I think.
Yeah.
Shoot there.
Well, I mean it figuratively. I don't mean it literally.
Yeah. No, I knew what you meant.
Take action. Yep.
Yeah.
So Jeff, what are some of your hobbies?
Well, you know, I've mentioned a lot of them. Travel's a big one. Writing is something I do now. And then I consider the real estate stuff a hobby at this point because I love it and I just kind of play around with it. But talking to people about real estate and networking, stuff like that, you know, it sounds lame when you say it, but like I've constructed a life that's surrounded around my hobbies. So like I dive, so I like to go scuba diving. So I try to do that 2 or 3 times a year. And then traveling in general. Those are probably the biggest ones. And then reading. I mean, you can see I got a million books behind me.
Yeah.
I do a lot of reading. I think I'm on pace to read about 60 books this year, so more than one a week.
Wow. That's incredible.
That's and you know, I try to rotate some nonfiction in there. So my goal is to read one nonfiction and then one fiction book. So about half and half. And that way I'm getting exposed to all these great thinkers and being able to expand my horizons and, you know, learn about things like multifamily. I read a book about multifamily. If I hadn't, I wouldn't have even known how awesome it was.
Mm-hmm.
So.
Right.
Very true.
Well, on that topic, what is the best business book that you've read?
Well, I mean, there's so many great ones. You know, the mindset ones are really, you know, probably the biggest ones. You know, I'm sure like almost everyone mentions like Kiyosaki's book and stuff, but as far as the multifamily book, and so I'm going to kind of narrow it down, and then your next question will be, what's the best multifamily book you ever read, right? But I like Brian Burke's book, Crushing It in Multifamily Real Estate. Brian Murray, I guess is his name. Brian Murray's book on Crushing It in Real Estate. And it's commercial real estate and multifamily. I don't remember the exact name, but it's something like that. Brian Murray, Crushing It in Multifamily and Commercial Real Estate.
Cool.
Awesome. Okay. And last question here. If there's one key piece of advice you could leave our listeners with about achieving success, what do you think it would be?
You know, decide what it is that success means to you. Because most people think, oh, I need to be successful, but they have no idea what it is. And, you know, you can be successful by making a whole bunch of money. But if you spend your whole life just piling up money and then you die with a big pile of money, I'm not sure that's successful. You know, I think Mother Teresa was really successful at what she wanted to do. She died super poor, right? But she fed like, you know, thousands and thousands of poor people. So if your goal is to be successful, you have to know what that means to you, because it's going to be different for everyone. So yeah, I definitely think that that's the key, is just know what it is you're shooting for.
That's great.
I love it. So Jeff, how can our listeners get in contact with you? Where can they see your show that you do, you guys put out? And
yeah, so my show is the Old Fashioned Real Estate Show, and it's we drink bourbon old fashions, right? So that's
very cool.
Literally just make an old fashioned and then sit down and talk about real estate on
that's
YouTube.
Awesome.
So it's youtube.com/old fashioned real estate, or just go to YouTube and type in old fashioned real estate. It
sounds like an excuse to just drink old fashions.
Yeah, well, so there's 2 reasons we did it, right? Like one, we thought it would be fun, right?
Yeah,
so,
absolutely.
You know, so it gave us an opportunity to drink in the middle of the day, because we usually film, you know,
that's
like
awesome.
in the middle of the day. And the other reason is because we were spending a lot of time networking with people and drinking with people anyway. And there's just so many people that want to learn this stuff. And we were like, you know, I was getting 3 or 4 calls a week from people that wanted to go out for a drink. And I was like, man, I'm drinking too much. So my show actually causes me to be able to drink less, if you can imagine that. Because I can like say, hey, you know what? I just talked about market cycles. You should watch my episode and you can drink with me on there. And then I don't have to go out and have a drink with you guys.
That's cool.
Very cool.
Yeah. So, I mean, that's the easiest way to find the show. We have a Facebook page, it's Old Fashioned Real Estate at Facebook and all that stuff too. But, and then me personally, I have a website, jeffreyholst.com, where I talk a little bit more about my life philosophy. I have a philosophy about not having bad days. So we have some stuff about that. I haven't had a bad day in like 25 years. So that's a fun thing. Yeah. I didn't even throw that in there.
Yeah. I need to figure that out.
Yeah. It's not as hard as it sounds. It's actually way easier than having bad days, because bad days suck. And even when I got sick, I was like, whatever, like I thought I'm going to die, but I've had a good life, so it could be worse. But it's all perspective, right? So that I talk about that and have some coaching and stuff like that we do on there too. So you can check that out.
That's so cool.
That's awesome. Well, Jeff, I think there's plenty of people that can aspire to have the lifestyle that you have and the motives that you've got. So I took away a lot from speaking with you today, and for our listeners, be sure to subscribe to the show so that you're not missing any of these awesome interviews. I mean, the 45 minutes of value that you just provided was excellent, and we appreciate you being on the show today. Also, make sure to follow us on Facebook at facebook.com/groups/wealthjunkies. And again, Jeff, we really appreciate it.
Thanks. I appreciate it, guys.
Thanks, Jeff. We'll see everyone tomorrow.
You've been listening to the Daily Wealth Junkie Show, brought to you by CEO Capital Partners. CEO Capital Partners works with business owners and executives to build passive income through multifamily apartment syndications. For more information about how you can invest in quality multifamily real estate assets and build significant streams of passive income, visit us today at ceocapitalpartners.com.